Acsis is an independent financial services group formed in 1999. It's wholly owned by Old Mutual. Cobie Le Grange is an investment analyst at Acsis. He joins us in studio to share their investment strategy in this rather volatile and uncertain market. Good to have you here, Cobie.
Thank you.
So what's your strategy? Because certainly volatility is the order of the day, as we've said, and I think there's a lot of talk about maintaining capital rather than having ambitions of return on capital.
Yeah, I mean, I think the one thing that you've got to think about is there's two ways kind of forward for Europe from this point forward. And you can see the market not quite sure where that is going to be. I suppose the one road for Europe is anarchy. You know, a complete meltdown as far as the euro is concerned, and as far as the system is what we call the euro system is concerned at this stage. And that might mean some members staying and some members going, but we're talking about a jolt to the system. We're talking about something that happens which basically takes people by complete surprise. The other way is for it to kind of just carry on the way in which it kind of carries on at the moment, and hopefully we get a little bit of growth out of that. You know, and if you get a little bit of GDP growth, like 0.5% or 1% per annum, that's okay, because you kind of just continuously seeing a revolvement of of money through the system, and at least from that perspective, you could potentially see the rest of the world start growing. And you can see the story of this year has been a kind of on the precipice. Will this happen? Won't it happen? Will this happen? Won't it happen? And that makes investing very, very difficult.
Is it Cobie, is it time to start planning for a breakup in the EU? Because all the analysis and most of what we read in financial markets centers around the debt, the rising bond yields in the Eurozone. No one's really looking at it saying, can we get a political solution here? Because all this running around by the central bank and the politicians, it's going to be settled by the politicians in my view. It seems unlikely to me. So what do you think is the road that investors should consider if you think that breaking up the Eurozone as it is going to happen?
You know, it's interesting you should mention this, because The Economist does fantastic work around this kind of stuff. And they actually showed a while ago, they showed Merkel's confidence rating in her by the Germans relative to a whole bunch of events that have happened over the last, let's call it last 8 years. And it looks specifically at economic events, but it also looks at other people being elected. And one of the big things that the European Union can get right at the moment is political stability. And unfortunately, at the core it's getting it right, but at the fringes it's not getting it right. The Greek elections is a fantastic example of not getting it right kind of at the periphery. And the question is, how do they get that right in order to ensure that they at least create some form of stability? Now, the issue is if they don't do this, then in essence you've got just a destabilizing factor where markets just sit on the sideline and they say we shouldn't be investing. If you look at equities, I mean, there's nothing fundamentally wrong with equities. There is fantastic value out in the market at the moment.
So you're sticking with equities then, in spite of the risk that you're highlighting. It seems as though this disaster scenario is a likelihood.
Well, I mean, you know, the big thing that you have to understand when you buy equities is that there's a time frame attached to owning equities, and there's a time frame attached to owning different qualities of equities. So if you're going to be owning equities, make sure that you own it for the long term. And that again becomes and translates specifically back to investor objectives. So you have to understand what those objectives are, how you're going to deal with those objectives, and how that translates into a time frame. Then you can start understanding risks as far as returns, as investments and returns are concerned at the end of the day. So the question is, are we buying equities? Well, again, it depends on the time frame, and it depends how you should be doing this at the end of the day.
And just in terms of that, Cobie, I just wanted to ask you, I mean, the focus is so here and now. We have this risk-on, risk-off trade that almost changes by the hour. What are your clients saying to you, and how are you keeping clients engaged for the long term? If you're a long-term stock picker and you believe in fundamental value over the long term at the moment in equities, what are you telling clients at this point to try and keep that perspective over the long term and not be sucked into this day in, day out mindset that seems to be plaguing the markets?
Well, I think the important thing again is to ensure that investors kind of look to the long term. So when you sit today and you set an objective for a client, ensure that they understand over what time frames they need to be committed to a specific investment strategy. Because once you reduce those time frames, then you just sit with volatility, which directly is driven by sentiment, which is all you're seeing at the moment in the market. Short term, stock price is influenced by sentiment. Long-term stock prices are influenced by earnings. Earnings are influenced by, well, dropping money out of the top line, which is turnover at the end of the day.
Right.
Now, I mean, those are the fundamentals at play, you know, and you've got to work with those. And the only way you can deal with those is making sure that you kind of carry on being stuck in for the long term. Let's take resources, for instance. I mean, China is slowing down. Okay, we can see at the GDP numbers, you can see the manufacturing numbers. Everything shows to a slowdown. Is China going to absolutely just kind of stonewall and stop growing? No, it's not going to happen. It'll probably carry on growing. What degree? We don't know. And that's what the uncertainty is about. But at the same time, it's giving you this fantastic opportunity to buy resources of single-digit price to earnings ratios. So do you participate or don't you participate? But I'd probably suggest that if you don't participate, you know, what are you doing? What else are you buying? Are you buying fundamentally overvalued stocks, you know, by not putting these things in your portfolios? Alternatively, how do you participate? Do you participate in one bang? Do you potentially buy and then wait? What is it that you do? Those are all about timing at the end of the day and understanding how you do that, but for the long term.
But this is the argument, Cobie, is that, you know, everyone's saying, yes, there's fundamental value in resources. You look at BHP and Xstrata and the likes of those. The problem that's facing investors is that the status quo is under threat at the moment. 2 years ago, if you said that the European Union was going to break up, or alternatively that Greece would exit the European Union, everyone would say absolutely no chance. We've just come out of a major financial crisis where the world as we thought it was fundamentally fractured. So to investors that are sitting on the sidelines and thinking, wow, there is value, you know, how much further can China slow down? And is there a possibility China can go into recession? You know, investors are confronting these fundamental shifts in their paradigms, and they're thinking perhaps I'll wait 6 months longer and get it for cheaper. I mean, there's such a big change occurring. Is it easy for investors and your clients to stay focused on the long term when the whole world seems to be turning upside down at the moment?
I'd like to suggest that, you know, picking the bottom is very, very difficult. Trying to find those asset classes, you can understand fundamental undervaluation. You can understand it. But picking the absolute bottom for the asset class becomes an impossibility. There's very, very few people that can get it right. As a matter of fact, I don't think they exist, quite frankly. And that's why when we participate in different asset classes and we buy up or we sell down in certain asset classes, we do so in a measured approach. So we try and understand it based upon its long-term objectives, trying to understand how it is that you need to invest. And often, I mean, and you make a good point, it's trying to make sure that you're taking investors with you on the journey. So making sure that investors have the opportunity and the ability to kind of sit down with you and say, okay, well, you know what, I understand the fundamentals and understand what's involved here. How do I now participate in this?
So it's very much sort of a close movement with your clients to manage this fear factor. Just you spoke about resources, and what I'm hearing there, and resources are known to be highly cyclical. So in this particular market, that uncertainty is even greater. Yes, single-digit valuations, but they've been there for some time, and the question is, when will there be that value unlock? If you look at other elements of the equity market, is there another perhaps more defensive, more sure, more sort of transparent earnings-generating sector?
I mean, the interesting thing is at the moment, you're seeing anything that is kind of robust earnings drivers, those businesses that have momentum around earnings and so on, those are all trading off very large price to earnings ratios at the moment. And at some point, your risk of this that you've got at the moment is that everybody is seeing this cataclysmic event potentially happening in Europe, and therefore kind of running to the safe assets and saying, well, look, if I buy a cigarette company or I buy, you know, a business that's in beverages, for instance, you know, at least maybe things will be okay. But you're paying a very, very, very dear price as far as this is concerned.
Our retailers certainly seem to be in that category with those very lofty valuations, and the question is, will that be justified? Time will tell whether those outside the sector or those within the sector are the true winners.
But you talk about general retailers. I mean, general retailers are I mean, if you just look at it on a correlation graph, so you just understand it from a mathematical perspective. If you look at price to earnings ratios and the returns you can get long term for buying stocks off the valuations that general retailers are at this stage, well, guess what? You're not going to make any money. It's pretty difficult to make money. It doesn't mean that you've never made money. It just means that you're going to battle to make money. And then the risk to the downside should tell you that maybe you should be pretty concerned about being in those sectors. The other side, if you want to be into food, is kind of the food producers, because the food producers are trading with way low, you know, price to earnings ratios. But again, there's a lot more bad news in that sector at this stage. Yes. Bad news, unfortunately, is the friend, or should I say, fortunately, is the friend of the long-term investor.
So could be financial stocks probably somewhere midway between resources and the retailers in terms of valuations. Yeah. Where do you see those return on equity under pressure, for instance, in the banking sector, and they need to invest and expand?
Yeah, I mean, specialist financial services businesses, you know, kind of trading just at the 10 PE, maybe slightly below. The bigger banks slightly ahead of that. You know, on a long-term average kind of valuation basis, they kind of averagely valued. We can't say they're cheap, they can't say they're expensive. And then you've got pressure on the downside potentially, especially when there's kind of earnings surprises that come out for some of the banks and some of those specialty financial services businesses. The question is, how do you participate in those, and what do you do at the end of the day? If you want to be in financials, well, you should be, if you've got a diversified portfolio, go pick the cheap ones. Be in the cheap ones and understand the risks that are involved in each one of those.
Well,
just to finish and round that discussion off, Cobie, so the way I've understood you is that at this point you'd be looking at fundamental value in the resources sector, probably avoiding some of the retailers, and the banks a bit of a mixed basket.
Well, generally what I'm saying is that if you're going to put together a multi-asset class portfolio, make sure that you have diversification, number one, diversification into those stocks or those asset classes which are fundamentally cheap from a valuation perspective, so that you have a margin of safety. And that's classic AKA Warren Buffett type terminology that I'm utilizing now. Make sure that you invest it over time, and make sure that time is directly related to objectives at the end of the day, and then make sure that you stay invested. Make sure that you don't become irrational. You know, the interesting thing is, in the crash of 2008, if you had to find the investors that were prepared to kind of participate in equity markets, people were saying to you, well, listen here, this thing's going to get even worse. There's no ways that this thing will ever sort itself out, you know. And hence, what kind of growth have we seen from those points? And again, we're sitting in a similar situation today. Is this the low? Is this the bottom? I have no idea.